Hello, everybody. It is 1 week to Halloween. Is it going to be very scary? I don't know. And nobody else does either. So when you read that article and it says, I have a magical voodoo formula that's going to say the market's going to go to 4,800 unless it doesn't, you could take that to the bank. It's either going to 4,800 or it's not. I just crack up anytime I see these articles with these very important headlines and then the pretentious puffery for like 9 paragraphs and 800 words. I know what I'm talking about. It's either going up or it's going down. God damn it. Listen to me. It just blows my mind, to be honest with you. So if you were reading Seeking Alpha this weekend, you know what I'm talking about. So anyway, retirement income options today. We're going to talk about REITs. I'm going to show you some charts. I want you to understand why REITs are good and why REITs are bad. Most REITs do not beat the S&P 500. There is this thumping and pounding that REITs, that's the way to invest. It's real estate. Yeah, okay, there's a little bit of truth to that. However, there's mostly not, and I can tell you why. The more I talk to private equity investors and family offices and rich people who can write the check to develop a property, and the construction companies that basically put a VIG on everything that gets built or remodeled, redesigned, redeveloped, you suddenly find out that the margins in real estate are somewhere between 20-ish% on the very low end and 50%, I'd say, on the high end, sometimes even a little higher than that. So why is it that most REITs are earning single digits? Because most REITs pay their dividend and have no capital appreciation. How is it that a local REIT company, actually a limited partnership company in Milwaukee, and there's 3 of them that I'm aware of, and I'm sure there's more that I'm not aware of, and there's a guy in Chicago that I know, how come they can all pay a 10% guaranteed dividend against their limited partnerships, and then use the 1031 exchange to roll properties into other deals and get capital appreciation to boot? How is it that companies that have invested money since 2016, 17-ish have doubled and tripled their money in that time frame while also paying out the 10% dividend? So effective, triples and quadruples. Why is that? And it's because REITs take a huge skim. And usually the executives at the REITs are not really invested in the REITs. Or if they are, it's for controlling interest, not because they're really making their money on the stock price appreciation and dividends. Certainly they'll get the dividend, but then they're also going to pay themselves an executive salary and give themselves free shares. So why is it that REITs don't really do all that well? So let's take a look at, let me prove it to you. Let's take a look at, there we go. Let's take a look at REITs. So this is all the REITs in the S&P 500 plus a couple dozen more that I follow. Take a look at the 5-year return here of the S&P 500. Take a look here at their return against the S&P 500 on a 5-year. Look at that. 49 companies, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 12, 13, 14, 15, 16, 17 out of 49 beat the S&P 500. That doesn't sound like the magical kingdom, does it? Take a look at this. Vernado Realty, Boston Properties, Ventus, Simon Group. Take a look at Simon against the S&P 500 over a decade. Trails it spectacular trailing of the S&P 500. Federal Real Estate, Essex, Welltower, Host, Weyerhaeuser. I actually think they have a legitimate thesis. Medical Properties Trust. Somebody asked about that stock recently. Well, here you go. Proof is in the numbers, right? An awful lot of red. Store Capital basically tracked the S&P 500 mainly on the back of Warren Buffett's investment, and they have a good thesis too. So why do all these good real estate theses not produce the numbers? It's the big skim. Executives take so much money out of most stock companies that it renders 3 out of 5 companies, completely uninvestable. The only reason they get investment is because the funds have to put their money somewhere. Another 1 out of 5 are, basically tracking the S&P 500. You have all of the return of the stock market in about 20% of the stocks. Everything else is even or negative. And that's why I pound on you have to have a great asset allocation to begin with that focuses on the big secular trends. the places where money is heading. Any industry that is having net distribution is going to lose. Any industry that is very heavily capital intensive, which means it relies on interest rates and financing, is going to face headwinds. It is the companies and the industries that are cash rich, that provide free cash flow for the investors, that don't have to borrow out of need, but can borrow out of strategery. Consider Apple. They've borrowed tens and tens of billions of dollars, hundreds of billions, I believe. Do they need the money? No, they were able to do an arbitrage. Said, well, we're investment grade. We can borrow as cheap as the treasury or cheaper, then reinvest that money somewhere else. So instead of just having it sit in the bank at a low interest rate, we actually borrow money and then reinvest it for a higher return. Did you know that's how George Steinbrenner bought the Yankees? He borrowed against his shipping company at a super low interest rate, and then reinvested and ended up with the Yankees. Pretty neat trick. So the more you come to understand finance, the more you realize that there's a lot of shell games, and the biggest shell game out there is the use of leverage and financing by companies so that the executives can have long enough periods of time where the share price does all right. People say, oh, I love this company. I made money this year. Meanwhile, they're taking all the real money out the back door, or really the front door. There's no shame in it. And that's why you get so many red numbers. And if you did the same thing with the S&P 500, and we'll do that one day, it looks the same. All the gains are concentrated at the top. So if you expand this to not just the 49 that I follow in a REIT world, and you take a look at this list, this is all of the US listed REITs over 300 million in America, 235 of them or something. These are the ones that beat the S&P 500 out of 235. Think that through. If you want to take a look at it over 3 years, same small group. Companies like Iron Mountain have confused me. They had a ton of execution risk. So I got away from Iron Mountain because I thought they were going to fail. Well, management figured it out. They didn't fail. Now it's priced too high for what they do and what they earn. But this is another company like Exxon that had huge execution risks and major headwinds, and Iron Mountain won. Exxon was, of course, saved by Engine Company 1 and high oil prices. If it wasn't for the oil prices, Engine Company 1 probably would have had to take Exxon through some sort of restructuring. Not sure if that would have meant bankruptcy or not, but there would have been massive dilution. So when you really learn what the companies do, what their finances are, and I've taken a liking to something that Sam Zell has said, we're cursed by knowing the numbers. And I know the numbers and the businesses that I get involved with. Now, there are companies on this list that are probably investable, but you run out of time to study dozens and dozens of companies. So what's the one thing that I think that you should take away from this? Let's take a look at the 5-year chart. On the 5-year chart, I want you to take a look at the industry. Industrial. You got a mortgage, got a residential, industrial. Vici is gambling. Residential, industrial. Specialty, this is Penn Gaming. Communications, farmland, and this is cloud storage now. Plus they have their legacy paper business. Public storage, classified as industrial. So of the industrial listings, they're either traditional industrial like you'd think of it, or they're storage space. And then the specialty, generally communications, something digital, or in a couple of cases, farmland. What aren't you seeing? You're not seeing retail REITs. They've really never been up there. They get a lot of excitement from investors. Oh, Simon Group is all that in a bag of chips. Really? Is Simon Group really all that in a bag of chips? I guess if you like crappy chips, Well, they got a fortress balance sheet. No, they don't. They have great management. No, they don't. They have a great business model. No, they don't. What Simon Property has is a major redevelopment problem that's so insanely difficult to navigate that they gave away 4 malls a couple years ago. One of which is down the street from me, and it's in a nice suburb. So now the city is redeveloping it by adding residential and offices, which is what you've heard me say about malls since 2009. Those of you who have read me that long would pretty much only be clients. But since I started publishing publicly in 2011, there is one trip I took where I took pictures of 4 malls, including one in Peoria, one near Beaver Falls, one in Philadelphia, and one in Newark. And these big shopping areas, the way they're designed, they just went the way of the dodo. I don't think there were bad ideas in the 50s and 60s when people had to go somewhere to shop, where it didn't need to be entertainment and eating too, just needed to be a place to get your shoes. So as you think about real estate and real estate investing, you really have to think about it at a much higher level. Not the, oh, look, it pays 7%. Yeah, for now. But if the stock price never goes up, why wouldn't you just buy a quality bond? You know, why wouldn't you buy preferred shares in a better company? If you're really just looking for the dividend, all stock investing is total return investing. And the sooner you accept that, the sooner you'll be a great investor. The sooner you will add a zero to your portfolio. All investing is total return investing. You can't just look at dividends. You have to look at the growth that supports those dividends, the growth that supports the free cash flow. And without those things, every company is pretty much destined to round trip. Might go up, but then they're going to come back down. And you can position trade those sometimes. And we talk about Freeport-McMoRan, classic boom and bust company. You buy it on the bust, you ride it up, you sell it. Don't become one of those people who are like, oh, copper's going to be expensive forever. No, it's not. Every shortage is met with more supply. Every glut is met with a pullback. So there are ways to trade certain things. With REITs, you can do that too. Some of these REITs are going to do very well off the bottom, and they're not that good at companies. But if you focus on the best ones, they'll do better. So another thing about investing is what? It's a relative return game. Do you want to have been in NNN, or would you have rather been in one of these ones that's green all the way across? Just had bigger numbers over 3 and 5 years. Yeah, over the last 2 years, NNN has beat the market by 15%. Okay, so let's take a look. But wouldn't any of these have been better? So when we take a look at REITs, let's think about it the right way. Understand the business, understand where the free cash flows come from, how they're going to create FFO, and what their capital needs really are going forward. Why do you think the storage REITs have done really well? What are their capital needs? Once they're built, do they have to do much? No, there's not much remodeling and improvements that has to go on with storage REITs. You know, maybe you repair a fence once in a while, put in a couple extra security cameras. It's not like a strip mall where every time a tenant rolls over, you have to change it. Or every time the tenant says, oh, people aren't coming, so let's, put up a new sign and light package and remodel the stores. And hey, can you tear down some walls and put up new ones? Or office towers. We talked off air about hybrid work being more productive than in-office work, where it's able to be done. Why are the offices not filled to capacity? I looked on LoopNet this week just to see what I could do for office space if I wanted to get a downtown office in Milwaukee. And it was obnoxious. There is so much office space out there. They put up their $20 or $30 a square foot price for the year. I just laugh. I know I can get them down to 12 for Class B. Class A would be a little bit more. But as one of those hybrid people, why would I ever rent an office ever again? I might buy a building, then put my office in it, and end up getting it for free. What I really need is a classroom. Big spot to put 20 people and teach a class. That's all I need. There's a lot of people like me. So when we take a look at real estate, you better really understand the reality. You can't glom onto the idea that, oh, everybody will go back. COVID wasn't a big deal. A, COVID was a big deal. And two, the genie's out of the bottle. Hybrid work, where hybrid work is possible, is going to be a thing forever. Obviously, you can't put a factory in your bedroom, your spare room. But if most of your work is on the computer, computers are pretty much everywhere now. Everybody's got Wi-Fi. A lot of us have the juiced up wire into the house so that we get 400 download and whatever upload we get. I don't know. It's just faster. Very reliable. By the way, AT&T made a whole lot of money installing that fiber that I told you about a year ago. That stock's bottomed out. It might double bottom. But if you're not in AT&T, that's one that you invest in the dividend because they have 3 growth catalysts. And one of the growth catalysts is spectacularly huge, which is if they can become a global telecom. And another one of the growth catalysts is the fiber, which every new construction in America is going to get forever now. And that's pretty high margin business because it's protected. It'll be an oligopoly in every market and a monopoly in some markets. All right, so what do I want to do? So I haven't published this yet, but it's coming. So rising interest rates mean only the highest quality REITs will navigate the Fed's new normal well. CapEx hungry companies that have to do a lot of remodeling and redevelopment, they're going to be a little stuck for a while. It doesn't mean that you can't pick them up off the ground. If they have a high enough beta, right, like Simon Property, if it gets completely destroyed again and gets down to the 2020 bottoms, you can buy that there. It probably won't set new highs, but it might get halfway or 2/3 of the way to the new highs. And that's a pretty good return to the old highs, I should say. If you are an accredited investor, you ought to really be thinking about buying investment property yourself or with a kid or a partner, or getting into limited partnerships. Limited partnerships is the easy way to do it. It's just like a REIT, basically. Can't trade it on an exchange. So you have to trust people involved and verify their finances, see what they've been doing. Make sure you can walk to one of their buildings and go, wow. So it's happened to me a few times. I went to one of their properties. I was like, oh, and you did this and this and this and this too. And your numbers look like this. So if you're a millionaire already and you're not talking about limited partnerships for investing in real estate, I would choose limited partnerships over REITs pretty much every day of the week. And when I do invest in REITs, it's because it's for people who aren't accredited and don't want to be in an illiquid investment. And I respect that. You need to have a lot of your money liquid. You can only really put into a partnership what you can do without for a long period of time. Most money can be made there, but it's also illiquid. You're not going to get your money out till it's time to get the money out. So in my REIT basket, which I've showed you, all the colored ones are ones that I follow. Store is off the list now because they're getting acquired. What we can do is go through our stock screener over at TradingView and then just rank by RSI. And here you can see that I'm on the monthly interval. What do we know about selling cash secured puts? You want to sell cash secured puts when a stock is oversold on the technical indicators, and the best shortcut is RSI. Normally, we use the weekly RSI. In a bull market, you use the weekly RSI and the daily. In the bear market, or I should actually explain that, the reason you use the daily and weekly charts in a bull market is because you're looking for pullbacks to buy. In a bear market, you're using the weekly and the monthly charts because you're looking for a bottom on the longer term time frames. So when the monthly charts get oversold, numbers in the 30s and lower, that's when you need to do your homework and say, okay, which of these companies are oversold but still worth something? Which ones are undervalued for what they're going to be worth in 3 to 5 years? You know which ones I think they are on this list. You know that I like all the satellite companies. I'm going to talk about investing in China here in a minute. Intel, they're going to converge in market cap with Taiwan Semiconductors the same way that Ford is converging with Tesla. Tesla's coming down a little bit. Ford's going up a lot. Taiwan Semiconductors is going to come down a little bit, already happening. Intel's going to go up a lot because instead of Taiwan Semiconductor essentially being a monopoly on contract semiconductors, Intel's going to now be part of an oligopoly with them. Same thing with Tesla and Ford and a handful of other EV producers. Tesla pretty much dominated EVs for years, but now all of a sudden Ford, GM, Volkswagen, a couple others are getting in there. It's still an oligopoly, still a huge market, still has growth in the emerging markets. Looks like the emerging markets are doing the most they can to skip the whole gasoline car phase. And then the kicker, of course, with Ford was the real estate and the fourth industrial revolution technology, which I think that GM probably also has. I just like Ford better, but you'd probably be okay splitting that investment up with GM, selling puts on both of them when the time came. Platform company. Here you go. Vornado Realty Trust. Vornado is hugely oversold. Then the question would be, how do we feel about that company long term? Let's take a look. I don't think we like it very much. Let's put it in order. Vornado. Oh, there you go. Nothing special there, right? Never beats the stock market. And yet, you see talking heads and people writing articles about, hey, take a look at Vornado. Not only has it not beat it since COVID, beat the market since COVID, it hasn't beat the stock market in 10 years. So we go through this, we take a look at where our companies pop up. And the thing is, the worst companies might be the most oversold, like Vornado. It might take you a little while to get to one of our companies. And maybe it won't get much more oversold. And if it does, it'll just be a little bit for a moment of time. Here's Crown Castle. I prefer American Tower, but again, this is another one where you could split up the investment between American Tower and Crown Castle if you decided to. Innovative Industrial Properties, what do we know about them? It's ranked by 5-year return. Innovative industrial properties, medical marijuana, and then what's their backdoor business? Their backdoor business, the one that has no value, is that it'd be very easy for them to get into greenhouse food production, which hasn't been a big winner so far. But as water and arable land become more scarce, as fertilizer becomes more expensive, you're going to see more and more greenhouse farming. And there's a hybrid model of this that I've looked into, which is why I wanted to buy that golf course a while back. So it had 60 acres that I could develop. I put greenhouses on part of it too, because it was on top of a peat bog. So I would have had 5 businesses running there, plus condos and apartments. It would have been pretty neat. And I would have done it with a limited partnership. So we want to look for these companies when they're oversold, because these are the better companies. So that's what I'm doing here. Going through the list, see where they are right now. Do they have a little bit more to fall? Why is it that there's not a lot of REITs that are oversold just yet? It's because if interest rates go up November 1st, 2nd, and the Fed chairman sounds scary, and he doesn't start to back off, the period between Fed meetings could be really bad, which I think is what they probably want. I think they want this market to set new lows. I think they want the S&P 500 below 3,000. And I think they want to put one more stake in the heart of inflation. We already know that the leading economic indicators, which we talked about a few weeks ago, are already starting to turn over. There's only a few holdouts, the main one being energy. Wages have not kept up with inflation in the last 6 months, or might even been 3 quarters now. So somehow the Fed has to engineer a soft landing. I don't think they're going to be able to do it anymore, because I think that Powell is going to be too hawkish for too long. That's what I think. I hope I'm wrong. I hope that he does what I think he should do, which is be hawkish on November 2nd and then really lighten up in the middle of December. And I think in December, he should declare victory and say, yeah, we only need to raise interest rates a quarter point this month. And we'll be data dependent going forward. We're not sure. We might be at the neutral interest rate and even a little bit to the tight side. We'll see what he says these next 2 meetings, because it makes all the difference. The reason that the REITs aren't completely beaten up yet, they're pretty beat up, but they have the potential for another leg down because, and this is more for the bad ones than the good ones, right? That's always the case. Is because if he does really decide to cause a recession, because he wants to break the back of labor, which is stupid and evil in my viewpoint. What super rich billionaire guy just went on TV and said that? It was over the weekend, some billionaire, I forget which one. But he was saying that if we cause high unemployment, people are going to look at this economy and just say, what the hell? I got a job. I was making money. I was taking care of myself. And you came to me to fix inflation rather than going to the people who have made the most money, which is the investors and the super wealthy. You will get a lot of FUs to the point where it could be destabilizing for society. I know somebody's telling Powell that, and I know the rich guys are telling Powell that. All the rich guys are saying, hey, keep raising interest rates because I can buy more of the world if you do that and crash prices for me. So we'll see what this guy says. And the magical voodoo trading systems don't know that, which is why you have to scale in slowly. I think selling cash secured puts is a great way to do it. And later today, I will finish this article up, put in probably a dozen trades for you, because there are certain things that are worth selling cash secured puts on. And I'll revisit some of the ones that we've already done so that new folks can get in, or you can roll yours into even more profitable positions. All right. I will let you go with that. And if you haven't carved your pumpkins yet, stop what you're doing. Go get some pumpkins. Spend a couple hours having fun, because you know what? This will still be there tomorrow. All right. Have a great day.